Our next arena of looking into amendments is what is the amendment in deduction. We have completed the 5 heads except house property. Wherever there are amendments, we have completed those heads. And then clubbing no amendment, set off only this small amendment of including banks and government companies for the amalgamating companies losses, and then moving into deductions. Okay, moving into, my dear friends, deductions. Again, the amendment is for individuals, and this amendment is only an extension. 80EEA. What is 80EEA? That is house property interest in excess of what is claimed in house property chapter, self-occupied 2 lakhs, in excess of 2 lakhs can be claimed provided some conditions are satisfied. That was till the financial year 31/3/20. This is extended to 21. Now it is further extended, but still this is extended to 21. Applicable for individuals. Stamp value of the property should not exceed 45 lakhs. Loan should be taken from a recognized institution. Loans can be taken after 19. Before it was only for 31/3/20, now 21, now export. Assessee should not be the owner of any residential property, and this property should also be self-occupied. Okay, this property should also be self-occupied by the assessee. This property should also be a self-occupied property. In these cases, the quantum of deduction, interest exceeding 2 lakhs, okay, or 1,50,000, whichever is less. Okay, so suppose if the interest comes to 3,10,000, up to 2 lakhs you would have claimed in house property chapter itself. So interest exceeding 2 lakhs is 1,10,000 or 1,50,000, whichever is less. So you can claim 110. Okay. Donation, here also this 2,000 is brought around. It was laying at 10,000, 2,000 here. Okay. 80 IAC, we know it's a deduction for startup. It's a deduction for startup. Okay. It should be a company or LLP whose gross turnover does not exceed 100 crores. Previously, this was just 25 crores. Now 100 crores in any previous year in which the deduction is claimed. Okay. Incorporated before March, and quantum 100% of profits for 3 consecutive years. Okay. Okay. 3, okay, commencing, not commencing, commending, it's commencing from the first year of operation. Okay, so the 25 crores becomes 100 crores, and 3 consecutive years from the first year, the 100% of the profits. This is that eligible startup where this ESOP also we are trying to issue and retain some employees. Housing project extended for 1 more year. It was supposed to end on 31/3/20, and it is extended. In this, I don't see a big questionable area except the next section, which is a more possibility or more clear of a questionable area. Okay. ATM, intercorporate dividend. This is a new section which is introduced. This is a new section which is introduced in the law. ATM, intercorporate dividend. Okay, so more from one domestic company investing in another domestic company or something like that. available only for domestic companies. Available only for domestic company. The gross total income of such domestic company includes dividend received from any of these entities. Okay, another domestic company, foreign company, or business trust. The gross total income will include dividend income. Normally, the same is taxable under section 115O, taxable as section 115O is withdrawn. Now, what is this deduction? However, where the receiving domestic company is distributing dividend, where the receiving domestic company, I got the dividend, I am also giving dividend to my shareholders. So, or cascading effect. I received a dividend from my company, from the companies I invested. That will be there on the credit side as my income. Okay. So on that now I have to pay tax because 115O is removed. I distribute dividend. Dividend can be distributed out of profits. Profit is after taking the dividend income also. I distributed dividend. The shareholder will also pay the tax. There is a cascading effect. To avoid that, this has been brought. However, where the receiving company is distributing this dividend, then deduction can be claimed. What is the deduction? Deduction shall be dividend received or dividend distributed 1 month before filing of returns, whichever is less. Repeat pandren. Deduction shall be whatever is the dividend received by me or dividend distributed for you all on or before 30th September 2021. For you all, whoever, whenever you are writing your examination, dividend received or dividend distributed on or before 30th September 2021. Because return filing for companies where audit is mandatory under company law, okay, so is 31st October. So dividend distributed 1 month before the due date of filing return. One exceptional case can be transfer pricing cases, but generally, let us take 30th September, whichever is less. This is like that audit 1 month provision.
Sir?
Raja?
Sir, is there any provision of how much percentage of holding should be there between the two domestic companies?
No. This is not specified or subsidiary and all. It is dividend. எவ்வளோ percentage hold பண்ணாலும், if you receive dividend, you will pay tax. Then on the distribution, somebody else will pay tax. It will cascade. So there is no percentage specification.
Thank you, sir.
First, let's complete 80EEA quickly. Question number 1. Chandrasekhar, a doctor working in private hospital, is in receipt of basic salary, special allowance, children education allowance. He as well as his employer pay 12% towards RPF, 10% towards pension fund. He has purchased on 1st May 2020, does not own any other property before this date. Okay, 43 lakhs, whereas the stamp value is only 40 lakhs. For this purpose, he took a loan of 40 lakhs from SBI at 8%. The property from the date of its purchase is self-occupied. Compute the income and the tax. Read through.
Sir, two children, sir.
Yeah, 2,400, right? This is not per child 2,500. For two children, 2,500.
Okay, okay, sir.
No excess contribution to PF. The total will not exceed 750. You need not check if you. Okay. House property, NAV of self-occupied property, NAV of self-occupied property nil, interest. How much is the interest? First, how much is the interest? He took a loan for a stamp value. He purchased a house. Okay, does not own. He took a loan for 40 lakhs. Okay, from SBI at 8%. 40 lakhs into 8%. Interest on borrowed capital. Okay, 40 lakhs into 8% into 11 by 12 because the house itself is purchased on 1st May 2020. Okay, so 11 by 12. Okay, 40 lakhs into 8% into 11 by 12. Okay, 2 lakhs 93. Okay, interest deduction restricted to, in this chapter I can only claim 2 lakhs. In this chapter I can only claim 2 lakhs. In this chapter I can only claim 2 lakhs. Okay, always have this also in our mind. Other sources. Okay, you should check whether the stamp value exceeds. Okay, right? Stamp value is only 40 lakhs. Okay, whereas the purchase price is 43. No problem. Only if it is reverse, you have to check. Okay, in this case, nil, no issues. Okay, so our gross total income. Deduction under chapter 6A. Deduction under chapter 6A, section 80C. Own payment to RPF or own contribution to RPF, this into 12%. That is basic salary into 12%. Okay. Own contribution to pension fund. Own contribution to pension fund also basic pay into 10%. Okay, both these things under section 80 CCD. Both these things under section 80 CCD. Okay, then section 80 CCD subsection 2, employer contribution to pension fund. Okay, it is allowed to the extent of 10%. He has only contributed 10%, so no problem, the entire amount is allowed. how the entire amount is allowed. Okay, okay, right. Now come to 80EEA. Okay, section 80EEA. All conditions satisfied. Property value, stamp value of the property has not exceeded 45 lakhs. Loan from a financial institution. House is self-occupied. Okay, and this is the first house. All conditions satisfied. Okay, interest exceeding rupees 2 lakhs. Interest exceeding rupees 2 lakhs. We computed the interest as 2,93,333 minus 2 lakhs. Okay, or maximum limit. Okay, 1,50,000, whichever is less. So this 93,333 can be claimed. Total income. Anyhow, rebate will be claimed, no tax. Question number 2. Bharatwaj Private Limited declares a total income of 90 lakhs, turnover of 1819 less than 400 crores. Total income includes dividend received from a domestic subsidiary 18 lakhs. The company declares a dividend of 15 lakhs in August and pays in September. Compute the income and tax payable. Will your answer change if the company has opted for alternative tax regime? Okay. Business or profession, 90 minus 50, 90 minus total income, the dividend received is 18 lakhs. So, business or profession will be 90 minus 18 lakhs. Okay. IFOS, that is dividend received, is 18 lakhs. Gross total income 72 plus 18, 90 lakhs. 72 plus 18, 90 lakhs. Deduction under section 80M. Deduction under section 80M. Okay, right? Dividend received 18 lakhs. Dividend distributed on or before 30th September 2021. Okay, dividend distributed is 15 lakhs. Whichever is less is going to be kind as deduction. Total income is 75 lakhs. Total income is 75 lakhs. Okay. Tax at the rate of 25% on such total income. Tax at the rate of 25% on such total income, and HEC at the rate of 4%, and HEC at the rate of 4%. So my total tax comes to 19,50,000. My total tax comes to 19,50,000. My total tax comes to 19,50,000. Okay, okay, right? The second part of the question asks us, will your answer change if it is, if the company opts for alternative tax regime? If the company opts for alternative tax regime, it's a non-manufacturing company. Okay. Deductions under chapter 6A cannot be claimed, but the beauty is, okay, except 80 JJAA and 80M. Deductions under Chapter 6A cannot be claimed in alternative tax mechanism. This morning we saw 115BAC, except 80CCD subsection 2 and 80JJAA. Leave 80LA for a minute, the IFSC. Okay, so here deduction under chapter 6A cannot be claimed, but still you can claim 80M also, 80JJAA and 80M. Okay, probably I have not written it as an amendment. Please take it out or somewhere, okay, in your notebook, just make a marking. Okay, so 80M can be claimed. Hence, the total income will not change. The total income will not change, my dear friends. It will continue to be 75 lakhs. It will continue to be 75 lakhs. Base tax at 22%. Base tax will be 22%. 1650 non-manufacturing. Manufacturing is the 15%. And surcharge at 10%. Okay. Remember, this is for you to understand. Remember, surcharge will be levied irrespective of total income under alternative regime. Okay, so surcharge at the rate of 10%. Okay, HEC, okay, 4%. HEC 4%. In this methodology, the alternative is preferable provided they have no brought forward losses, etc. Alternative tax regime is preferable. Okay, because in this method your AMT will also not apply. Okay, so 115 JB will also not apply MAT provisions. Okay, so alternative tax is preferable because you can claim 80M. apart from 80 JJAA, you can also claim 80M. So this alternative tax is okay, applicable. I will do a question when I do revision class. Okay, if it is a manufacturing company, because something interesting. அப்போ என்ன ஆகும்னா, if it is a manufacturing company, okay, business income is taxable at 15%, whereas the dividend income, any other income will be taxable at 22%, plus 10% surcharge, 4% HEC for both. Repeating, manufacturing company which has commenced operation after 1/10/2019, what is the speciality? Their income is taxable at 15%. That is a wrong understanding. Their business income or income arising from manufacturing activity is taxable at 15%, whereas all other incomes are taxable at 22%, and then special rates are still applicable. Okay, when we do, I know that I have a question in revision class how to compute. Okay, if it is manufacturing, non-manufacturing, we'll do a chart and see in a question so that you will be clear. Just I told to just make you remember that, nothing else. Okay. Question number 3. Write note on various types of dividend and its taxability. Dividend from domestic company, taxable in the hands of shareholder. Taxable because 115O is removed. Taxable in the hands of shareholder. Okay, where the shareholder is a company, then ATM can be claimed. ATM can be claimed provided other conditions are satisfied. That is, they should in turn distribute the dividend within the due date. Okay, dividend from domestic company. Okay, this is the provision. Dividend from domestic company, this is the provision. Okay, surcharge on dividend. Surcharge on dividend. Okay, in case of individuals, HUF, artificial judicial person, AJI. Okay, surcharge will not exceed 15% on dividend tax, even though the total income exceeds 2 crores or 5 crores. This morning again we saw this. So just since I am consolidating the provision, if I consolidate at one particular place, you will be able to appreciate it. So that's why I have written this. Okay. Okay. Dividend from specified foreign company. In fact, our friend was asking, Saurav was asking about this only. That is specified. Ingeda irka percentage. That was his question. So we could infer why he was asking that question is because there is a section called Section 115 BBD, which was taxing specified. Okay, where 26% or more of the voting power of a foreign company is held by an Indian company, then such foreign company becomes specified foreign company. Then it becomes a specified foreign company. Okay, dividend income is taxable at the rate of 15%. There is a special rate of taxation for that dividend. Okay, that dividend is taxable only at 15%. That dividend is taxable only at 15%. Dividend from other foreign companies, that is other than specified companies and cooperative societies. Okay, taxable as at normal rates. Even last year these were taxable. Even last year these were taxable. Only domestic company dividend had some special provision. These were taxable. And then comes deemed dividend. Okay, we all know that is loan or advance received by a substantial interest holder. Okay, from a company, from a closely held company, not a listed company, unlisted company, or a closely held company, private limited and closely held public limited companies. Okay, deemed dividend. Okay, taxable in the hands of the receiver. Taxable, this again was amended. Okay, pre-amendment, post-amendment, everything happened in this. Now it is settled that it is taxable in the hands of receiver. Taxable in the hands of the receiver. Okay, dividend from business trust. Dividend from business trust. This alone, please wait for some time. I will come back and write. I will come back and write. These are all the various dividend and its taxability. Business trust, I will write.
The dividend received by cooperative society or
Inurvati?
Dividend received by a cooperative society.
Dividend received by a is exempt. I'll come to that.
Okay.
Cooperative society taniya நான் படிக்க போறோம். Okay. With this, we are over with the income computation part. We have to go for the assessment, that is grossing up part. I am repeating. Okay, in deductions chapter, ATM is a very questionable area. Very questionable area. So be clear. EEA rarely a questionable area. I don't think they will stop at the inter about those questions. Okay, and the various other aspects. Am I clear to you? Okay, right? Yes, sir.
Sir, in all the above dividends, except dividend from specified foreign company, we have deduction under section 57, right?
Yes, sir.
20% interest.
Yes, 20%. Yes, sir. Very good understanding. Yes, sir.
Thank you, sir.
Okay. Assessment of cooperative society. Assessment of cooperative society, because there is again an amendment and there is a chance of question. Okay, there is a chance of question. Okay, so a quick look at what is cooperative society. Section 219 is a cooperative society registered under the Cooperative Societies Act or any other law. Okay, and for the time being in force. Okay, we understand that registration is the only criteria to classify it as cooperative society. Okay, it is taxable, it is treated as a separate assessable entity. Okay, computation should be made, okay, under each head depending upon, okay. Entrance fees by a cooperative society from its members is taxable as its income, irrespective of its nature of business. Okay, there was a long pending dispute. Those are now resolved. Okay, I am directly going into computation of income. They have a one particular deduction which is their nerve, ATP. Okay, they have one particular deduction. Okay, exclusively for cooperative societies. That's what I was telling our friend also now. Please wait. Okay, 100% of the profits included in the gross total income from what? Carrying on a business of banking or providing credit facility to its member by a primary agricultural credit society or primary cooperative agricultural and rural development bank. In the provision, remember tomorrow morning in TDS we will again recollect this. Okay, now they are going to deduct tax on this. Okay, normally when they pay to the members they are not taxing it. Now from this year they are going to deduct tax from it. Okay, coming back, carrying on the business of banking or providing credit facility to its members by whom? By a primary agricultural credit society or cooperative agricultural or rural development. Cottage industry, agricultural produce grown by its members. Okay, in Tamil Nadu this is popularly known as Ulavar Sandai. Okay, purchase and supply to its members agricultural implements, seeds, livestock or other articles intended for agriculture for the supply of its member, processing without the aid of power agriculture, collective disposal of labor, fishing and other allied activities. Primary society engaged in supplying milk in the Gujarat Cooperative Milk Federation. Oil seeds, fruits or vegetables raised or grown by its members. Okay, dividend, that is what our friend was asking me. Okay, dividend or interest received by the cooperative society from its investment with any other cooperative society. With any other cooperative society, if they receive any dividend or interest, it is not taxable. Income derived from letting godowns or warehouse for storage of produce, and income from house property in the case of housing society engaged in the performance of manufacturing activity with the aid of power. Please read through one. Ellame agriculture based, primary agriculture based. Okay. Now the optional tax regime. Now the optional tax regime, unfortunately, the section number is not friendly to them. 115 BAD. Introduction from Finance Act for Cooperative Societies. If other conditions are satisfied, then the income will be taxable like a non-manufacturing company. 22% plus 10% plus 4%. Just now we worked out. 22% plus 10% plus 4%. If other conditions are satisfied. What conditions needs to be satisfied? Same like what we studied in BAC. No 10AA, no additional depreciation, no investment allowance, no deposit based, no scientific research, no specified business, no agricultural extension that deduction, except 80 JJAA and 80 LA, again for IFSC. Set off of losses. If the brought forward loss is due to any of the above said items, then it cannot be. இதுல வந்து additional depreciation தான். Okay. Similarly, loss arising from house property cannot be set off. AMT provisions will not be applicable. Okay. Adjustment to be made for the unadjusted additional depreciation. Okay. So, and then the law says the option has to be made before filing the return. Where the option is once exercised, it cannot be revoked. And where there is a default, the assessee can never come back into the scheme. Same like whatever we studied under 115 BAC.
Sir, what is that exact amendment in cooperative society?
In introduction of 115 BAD.
Oh, okay.
No other amendment. A primary agricultural society offers the following information. Compute the tax repayable under the normal tax regime as well as the alternative tax regime. Net income from carrying on business by giving credit to its members, ATP deduction. Okay, remember it is a primary agricultural cooperative society and it is giving credit only to its members. Net income from carrying on banking business by giving credit to non-members taxable. ATP la you will not claim deduction. Income from marketing agricultural produce grown by its members, exempt. Grown by its non-members. Okay, I told you this is like Uravar Sandai. Okay, non-members taxable. Dividend from investment made in another cooperative society, deduction allowed. Dividend from other investments taxable. Interest from deposit made with cooperative society, a deduction allowed. Other interest taxable. LTCG on sale of assets normally taxable. Normally taxable. Read through. Read through. One minute, friends. Small clarification. Okay. These four are the ATP qualifying deductions: 17 lakh 5,000, 9 lakh 10,000, 23 lakh 10,000, and 3 lakh 5,000. I take this opportunity to tell you the cooperative society rates also. Please remember this examination, be it November holiday, they can ask tax on total income. Okay, first I will write the rates. Okay, up to rupees 10,000. Okay, it is 10%. Up to rupees 10,000, it is 10%. 10,000 to 20,000. Okay, 10,000 to 20,000, 20%. Okay, the rate is 20%. 10,000 to 20,000. Okay, 20,000 to 30,000 is 30%. 20,000 to 30,000, no, sorry, exceeding 20,000 is 30%. Exceeding 20,000 is 30%. Repeating, up to 10,000, 10%. 10,000 to 20,000, 20%. And exceeding 20,000 is 30%. So, in this case, this will be 10,000 into 10%. This will be additional 10,000 into 20%. We call this as 3,000 plus 30%. So it is exceeding 20,000. So here it will be 5190 minus 20,000 into, no, 5190 minus income taxable at special rate 2140 minus 20,000 into 30%. That is, okay, leave around the LTCG, leave around the LTCG because, okay, LTCG, okay, LTCG or is taxable at 20%. LTCG is taxable at 20%. So this 21,40,000 of LTCG is taxable at 20%. Income has not exceeded 1 crore, no surcharge.
Sir,
Raja? Yes, Aurav.
sir, generally in a question, if nothing is given, we do not assume it to be a 112A asset, no, sir.
Once more. Yeah, we should assume it as 112 only and not 112A. If it is 112A, they will specify that STT is paid. Where cooperative society opts for optional tax regime. Gross total income slash total income. So the gross total income becomes the total income itself. Okay, deduction cannot be claimed. To be more specific, deduction cannot be claimed. The ATP cannot be claimed. Only ATJJAA and ATLA, that is for IFC. Okay, so this becomes, okay, now tax at the rate of uh, LTCG taxable at 20%. That will never change. That will never change. Okay, always special rates or special rates. That will not change. Okay, other incomes taxable at 22%. Other incomes taxable at 22%. LTCG is a special rate. If there is STCG, 15%. Not only here, company also. Okay, only their business income, IFOS and all will change. So this into 20%. This into 22%. Okay. And surcharge at 10%. Mandatory surcharge. Add, okay, HEC at 4%. Not only here, my dear friends, not only in the case of cooperative society, even 115 BAA, BAB, you have the same principles. That is, any special rates taxation, that rate. Only other incomes, business incomes will be taxable at 22% plus 10% plus 4%. Till 80P is there, cooperative societies will not opt for 115 BAD, but there can be a question. There can be a question either in the forthcoming or in the November examination. Okay, be clear about it. Now, again, one more most questionable area. Okay, because of dividend, there is a change in the holistic provision of REIT and investment trust. Because of dividend, we are reading, we are knowing this. Okay, we are aware these are pass-through entities. Pass-through entities now. This REIT or investment trust is a middleman between the unit holder and the SPV or any other investing entity. Whatever they get, they have to give it to the unit holder. Okay, the core income shall be taxable in the hands of ultimate beneficiary, that is unit holder, and the non-core income, their non-main source, will be taxable in the hands of the trust. Since dividend income is taxable in the hands of the recipient, there are few changes in the provision. Rumba simple change தான், but அதுக்கு ரொம்ப பயங்கரமா எல்லாரும் ஏதோ REIT sure question அதுன்றாங்க. So dividend income from special purpose vehicle. Dividend income from special purpose vehicle. It all depends upon whether the SPV is paying tax as per normal tax regime or as per optional tax regime. Once more repeating, the whole thing depends upon, the dividend income depends upon taxation in the hands of the unit holder, depends upon where SPV pays tax as per normal provision. Where SPV pays tax as per normal provision, not taxable in the hands of the business trust, not taxable in the hands of the unit holder, exempt at all places. Where SPV pays tax, in the dividend income is not allowed as an expenditure. So SPV has already paid tax for this. Where SPV has already paid tax as per normal provision. Already paid them, but still, okay, lower level. Okay, exempt. Where SPV pays tax as per alternative tax regime, where SPV pays tax as per this, my dear friends, alternative tax regime. SPV is not paying as per normal provision. SPV pays as per alternative tax regime. Then it becomes taxable in the hands of the unit holder. Then it becomes taxable in the hands of the unit holder. So, whether dividend income is taxable in the hands of the unit holder யாரா வேணா இருக்கலாம். யூனிட் ஹோல்டர் இண்டிவிஜுவலா இருக்கலாம், HUF இருக்கலாம், கம்பெனியா இருக்கலாம். Just now we saw dividend income received by a company will be exempt if they have distributed it. Okay, so when it is exempt or when it is becoming taxable, when the SPV who is distributing it, when the SPV who is distributing it is following alternative tax regime, then the dividend income is taxable in the hands of the unit holder. Anyhow, it is exempt in the hands of the business trust. இதுதான் amendment. நமக்கு தெரிஞ்சதுதான். All others are same. This is the amendment. Okay, but hue cry is taking place. Big amendment. தெரியல, knowledge கம்மியா இருக்கு. Okay, interest income from SPV, we know it is not taxable in the hands of the business trust, taxable in the hands of the unit holder. Taxable in the hands of the unit holder, the TDS taniya I'll teach you. Rental income, not taxable in the hands of the business trust, taxable in the hands of the unit holder. So these are the core incomes. Interest, dividend and rental income, these are the core incomes. All other incomes are non-core. Non-core na very rare, so they will be taxable in the hands of the trust and not in the hands of the individual. STCG on which STT is paid, LTCG on which STT is paid, general LTCG. Any other income is taxable at MMR. Any other income is taxable at MMR or in the hands of the trust, all these four, and it is exempt in the hands of the unit holder. Look through this table once before going into TDS table.
Sir,
Sollu Raja.
sir, when SPV is following normal provisions, could you explain the taxability of dividend because it's not taxed in both hands?
Could you explain taxability of dividend? Actually, no big difference. Anyhow, SPV is going to pay tax on the dividend. Dividend is not going to be allowed as a deduction while computing your total income. Okay, while computing your total income, dividend. In that case, SPV would have paid 25 or 30% at a higher tax rate, so they are getting exempt in the other two hands. Whereas here they are paying it at the lower tax rate of 22 plus 10 plus 4. Okay, so it is getting taxable in the hands of the unit holder. That is the only logic because of which it is taxable.
Yes.
now the TDS, because when we write the answer, we need to answer it comprehensively. Since there is some possibility of the question, let's highlight the answer very comprehensively for whom, how, what. Okay, distribution of dividend income received from SPV which has opted for normal tax regime. We know that it is not taxable, so there is no question of deducting TDS. When the SPV has opted for normal tax regime, that means the dividend is not going to be taxable either in the hands of the trust or in the hands of the unit holder. So tax is not liable to be deducted. Tax is not liable to be deducted. In that case, tax is not liable to be deducted. Distribution of dividend income by an SPV which has opted for alternative tax regime, 10% is the tax rate. 10% is the tax rate, be it resident or non-resident, because it is taxable. Interest income received from SPV, taxable in the hands of unit holder, 10%, 5%. Rental income, 10%, rates in force.
Sir, we have these COVID rates also, sir, this time.
Yes, sir. Yes, sir. I will teach you when I am teaching you TDS, sir. In case of resident, the rate will be 7.5% if the distribution is between 14th and 31st, 14th May and 31st March. இது கொஸ்டின் பண்ணுவாங்களான்னு எனக்கு இப்போ டவுட்ஃபுல்லா இருக்கு, பிகாஸ் வாட் இஸ் த பாயிண்ட் ஆஃப் ரைட்டிங் இன் த மந்த் ஆஃப் June 2021 about a rate which was prevailing. Now they have not, in fact, COVID is more now. Okay, that let's not talk about that now. Okay, anyhow. A question which we have covered in our classroom. Okay, just to your understanding. Question. A business trust registered under the SEBI gives you the following: interest income from Beta Limited, dividend income from Beta Limited, short-term capital gains on sale of listed shares from Beta Limited, short-term capital gains on development properties, interest from unlisted debentures, rental income. Beta Limited is an Indian company in which the business trust hold controlling interest. It's a SPV. Discuss tax consequence of the above income earned by the business trust in the hands of the trust as well as unit holder, assuming that the business trust has distributed 10 crores. Okay, right? We all know this question. A small adjustment only needs to be made. Okay. Nature of income, business trust, and unit holder. Okay, you have a lengthier column. I'm having a short columns. You have equal columns. In fact, this is a smaller column. Those two are lengthier column. Please have it like that in your notebook. Okay, interest income from SPV. Okay, not taxable or exempt. You can use the same word, exempt. 1023 FC. 1023 FC. How to remember that? If it is FCA, that is U, and that is for rent. So remember it as FC. Okay, exempt under 1023 FC. Okay, tax has to be deducted. You know, it is 10% or 5%. 10% resident assessee and 5% non-resident assessee. Taxable, okay. Component of interest will be, okay, what is distributed is 10 crores. What is distributed is 10 crores. You can see they have distributed 10 crores. Okay. What is the total income of the SPV? 4 plus 2, 6. 6 plus 1.5, 7.5, 8.5, 8.6, 10, 11.1. 11.1. Okay. Repeating, 10 crores into 4 divided by 11.1. This is the component. This is the component of interest. The law says the distribution will be in the same proportion in which the trust got the money. Distribution will be in the same proportion in which the trust got the money. Adanalata, the trust has to send a statement, AIR, annual information report, before 30th June to the unit holders, okay, so that the unit holders can file their return based upon that. So trust has to give the unit holder, look, this is the distribution, this is how I have earned it, and you are supposed to classify it. Okay, right. Dividend from SPV. If the SPV has opted for normal tax, okay, exempt, okay, exempt, okay. If the SPV has opted for, okay, optional tax regime, exempt, taxable, okay, component, okay, how will I compute, okay, and that is the distributed amount into 2 divided by 11.1. Okay, this is how they will compute. Or company kuda ippadidan compute panni, they will say what is the dividend income, anything. Okay, dividend income. This is the only change. All other things are like before only. There is no change. Okay. So STT would have been paid, okay, taxable under section 111A, taxable under section 111A, exempt, taxable under section 111A and exempt. So business trust will pay the tax. STCG on sale of development properties, taxable at MMR 42.744%, taxable at MMR, exempt. Component you know how to compute, 10 into whatever is distributed divided by 11.1. Okay. Yes, interest from unlisted debentures, not from an SPV, taxable at MMR, exempt. Rental income, exempt, and a TDS provision applicable, taxable. component, you all know 10 into 2.5 divided by 11.1. It is a theoretical answer, not a computation. It is always a theoretical answer, not a computation. Okay, okay. That sets the ball rolling towards TDS chapter, okay, which has lot of amendments. Both lot of amendments then ரெண்டு மூணு sections 194N, 194O, okay, like this. Some sections and 194C, the small things, okay, that sets the ball rolling for TDS, and TCS has two new sections, that is for authorized dealers and for sale of goods, that is the 2061H. Okay, so both the exams, forthcoming exam as well as the November exams, TDS and TCS, there are a lot of scope for questioning. Okay, so as of now I stop here to make rolling tomorrow morning. Tomorrow morning, in my opinion, TDS will be taking, including the practical question. Let's take 1 hour, 1 hour, 15 minutes. Similarly, TCS will also. And then we will take a break and then go for faceless assessment and faceless appeal. Those two are pure theory. Okay, pure theory, again questionable areas, faceless assessment, faceless appeal, leaving the whatever we are missing it out, whatever we are unable to cover, we will cover it tomorrow evening along with non-resident provisions. As I told you, non-resident does not have much of amendment. Okay, only the resident sites has some amendments. So meet you tomorrow morning 6 o'clock sharp, okay, to continue with our amendments understanding and to progress on. All the best, friends.
Sir, till whatever we have done, is it possible to put this Excel file alone in the group, sir?
This is all yours. Yeah, I will do that.
Thank you, sir.